everyone. So today we're going to go over our Equity Booster program, which is a bridge loan. For those of you not familiar with it, a bridge loan is a short-term loan, which is going to be put in place to bridge the gap between a house you currently own as a primary and one that you're looking to buy. It is not a product that is created as a standalone to buy a home. It is something that is used as a short-term temporary solution to access equity as a down payment. So it is put in place as a second mortgage on the current primary. Once it's sold, it is then paid off. So a lot of things we're going to go into today. Occupancy. So an occupancy for a bridge loan, it must be on a primary residence and used to purchase a new primary residence. So in other words, you're currently living in a home that is your primary residence. We're going to utilize a bridge loan to access equity in that primary residence to buy a new primary. We can't access equity in a second home or in an investment property to buy a primary, because those are typically things, once you have it, you won't sell. That would be where a home equity line of credit or something like that comes in. You also see the states here that we can lend in. This product is ours. This is not something we're going to another bank or doing a second mortgage to them. So it is a quick process, but because of that, there's only certain states we're going to lend in. So terms and interest rate. It is a 12-month interest-only loan. So it is based on prime, so it is a variable rate. So today's prime rate, 8.5%, plus 3% would be 11.5% would be the interest rate on the money you borrow. So for loan amounts and LTVs, we'll lend $25,000 to $300,000, depending on the LTV, CLTV. CLTV is a combined loan to value. So if you already have one loan on there, the second one would be the bridge. Both together give you a CLTV. Minimum credit score we require for this is a 700. And then what fees do we have? Well, it is a loan. We are processing it. There are some costs, third-party costs associated with it. There's a $500 processing fee, and we charge 1 point origination. There is a standard appraisal on the current primary residence, just so we can verify the value for us in-house. And then standard title and recording fees for that. Qualifying. So as a borrower, typically we already have that borrower in-house. They've been qualified to buy their new property. If we're going to put a bridge in place, the new mortgage plus mortgage payment on the departing residence or current primary residence plus the bridge loan payment all have to go into place for calculating debt to income ratio for qualifying. Now, if there is no mortgage on your current primary residence and we do a bridge, we don't count the payment. Another way to look at too is if they have a small mortgage, say $50,000, we can use the bridge to pay off that mortgage. So there is none, it's mortgage free. There's just a bridge loan in place, take the money out that is needed for the purchase. We don't have to count that payment in qualifying as well. And then it comes down to the type of program we're doing, whether it's a VA, conventional, FHA on the new purchase for qualifying. So the beautiful part about this is, again, this is our product. It is underwritten and processed in-house. We'll use the same underwriter for this and the purchase. So to make it easy, everything moves along at the same time. We closed a bridge loan 3 days prior to the purchase of the new home because of right of rescission. It is technically a refinance. And then we'll use the same title company. So title company that's going to close the purchase will close the bridge loan. 3 days, the money's available. They'll go back to the title company for the purchase of their new home. So let's say they were to close on the 31st of the month. Typically, their first payment is due 30 days later. The idea would be the house is already prepped, listed. The house sells within a 30-day time period. They never actually have to make a payment on the bridge loan, which is the beautiful part about it. We can also look at possibly escrowing that second payment to maybe so they don't have a payment for 60 days, just to make it easier on the buyers. So all of this, because it is an in-house product, is something we can take up case by case. Remember, 80% loan to value. That is case by case. If you're borrowing less, no problem. The rate doesn't change. But typically what we're doing is we're underwriting and looking at the property they have for sale. It helps with you, the agent, provide a CMA. It's already listed for sale. We see that. That gives us an idea of what it's worth so that we can preliminary approve the borrower as they're looking for homes. Once they go under contract, the processing of both the new purchase and the bridge begin. So it's nice and easy. We don't want to close the bridge now and in 6 months they find a house to buy, because they're going to be making payments the entire time. We sit, preliminary approve them just like we do for a purchase, and then close both relatively quickly or close together. So I hope you've learned a little bit more about bridge loans. If you have any questions, let me know. I am happy at any time to jump on a call or do emails with you. You guys have a wonderful day. I'll talk to you soon.